In this video, I'm going to show you how to profitably swing trade SPY and QQQ options. I'm even going to show you a foolproof strategy that is going to win 95% of the time. So let's go ahead and jump into it. As you can see, in the past 6 months, in just this one account right here, I've made $162,000 and with a gain-loss ratio of 90%, meaning I'm winning 9 times out of 10. And I'm even going to show you this exact strategy right here. This is a back testing tool on Tasty Trade, one of my brokerage accounts. And as you can see, this strategy works in some of the worst markets. This is a bullish strategy that worked through the 2022 inflation-induced bear market. So as you can see, from January 3rd, 2022 to October 1st, 2022, this strategy, returned 21% in that time frame versus the overall market, or QQQ, was down 30%. So this would have made you 20% versus losing you 30%. And I'm going to show you how this strategy works and why it even works better in a bear market and a bull market. It works great in both. Now, before we jump into it, make sure to hit the subscribe button down below this video. And if you get any value out of this video, please hit the thumbs up, as that helps it boost in the algorithm. Now, also, I do have mentorship if you want to make 6 figures trading. That'll be in the first link in the description. I also give away free trade ideas on my free newsletter down below and Instagram. So make sure to be subscribed to both. Now, let's go ahead and jump into it. How to trade SPY and QQQ options profitably, okay? It comes down to 4 specific principles I want to talk about that not many traders talk about, all right? The most important principle is understanding the VIX. Now, if you don't know what the VIX is, I need to teach you, because this is the #1 indicator that has made me hundreds of thousands of dollars. And if I didn't follow this indicator, then I would have lost a lot of money, okay? So the VIX is basically the fear and volatility index of the S&P 500. So it's pricing in the volatility in the options and futures of the S&P 500. So as you can see, there's different levels. When there's a lot of fear in the market, the VIX will be very high. And when there's no fear in the market and just complete greed, the VIX will be low, like in these periods, okay? And basically, every time the market dips, if we go over to QQQ, you could see that we dipped really big last August in 2024. This was one of the biggest sell-offs since 2020. All right, we could see on the VIX that the VIX spiked up to an all-time high of 67. This thing printed all the way up here, and that was the largest spike we've seen since 2020, okay, in the VIX. So this was maximum fear, and this was the best time to get in. Now, if we look at the VIX, okay, and we'll talk about the other 4 principles, but let's take a look at the VIX. When VIX is high, options premiums are usually overpriced, okay, therefore giving you a key advantage. So if you are buying options when the VIX is high, this is not always the best idea. But if you are selling options when the VIX is high, you're basically selling overpriced options, and those options tend to expire worthless, which is good for the option seller, okay? Now, let's focus less on the strategy, but more on the VIX and how I use the VIX. So when the VIX is between 10 and 15, that's telling me that, okay, the VIX is sub 15, the market's greedy. We're probably making new all-time highs. And that's kind of where we're at now. We broke to new all-time highs just a little bit ago, and it doesn't matter when you're watching this, just look at it for the principles. Broke out to new all-time highs on QQQ, and the VIX is currently at 15, okay? So I expect as we climb higher, right, maybe the QQQ goes up to 550, the VIX will go down to maybe 14, 13, or even 12. We saw it as low as 11 back in, July of 2024, all right? So the VIX will head lower and the market will get more greedy. That means you don't want to allocate all of your capital when there is a lot of greed, because what can happen is the president could announce something, maybe a new tariff or new news, and that could send the market downwards and the VIX upwards. And what's going to happen if you're 100% allocated, you're going to have no cash to take advantage of certain trades. Also, the current trades that you're in, if they're bullish, you are going to be down significantly on them, okay? So that is why you have to understand portfolio allocation before getting into trading, because you shouldn't be using all of your capital at all times. It should depend on where the market is and where the fear is in the market. Okay, so 10 to 15, 20 to 40% of the portfolio is allocated, right? Where we are at now, between 15 and 20, 40 to 80% of the portfolio is allocated. I'm allocating like 80 to 90% just because I'm super bullish this year, okay? Now, whenever you're watching this, you'll have to kind of adjust and see where the VIX is at. If VIX is above 20 to 30, I'm 100% allocated. That is the best time to get bullish, when there's a lot of fear in the market, because usually the VIX will revert back to the mean. Every time there's a lot of fear, boom, spikes. The next day or the next couple days, this thing just tanks and the market rebounds, okay? As we saw here, rebounded. If we look at QQQ, right, we tanked and then rebounded super quick, right? And it happens every single time. We tanked probably here, December 18th. Let's take a look at QQQ, right? Yeah, we did. We tanked down to here and then we rebounded the next few days. All right, so that tends to happen very often. So that's basically what the VIX is, and how that applies to this particular backtesting tool. And we'll get into the exact strategy later on in the video, but I just want to show you that I set the backtesting tool to VIX between 25 and 40 during the bear market. So like we said, right, if we look at the VIX at the capital allocations, when VIX is above 20, you should be 100% allocated. And that's how I played it on this particular strategy. Between 25 and 40, when the VIX is there, I'm 100% allocated and I'm making a lot of money, 21% in a bear market. That's almost unheard of, right? Most fund managers did negative that year, okay? So we'll come back to this and I'll show you the exact strategy that I did, but I want you to understand the VIX first, okay? So now that you understand the VIX and capital allocation, right? This is how the biggest hedge fund managers and institutions manage their money, right? Now you can manage your portfolio like the big boys, okay? So you understand portfolio allocation, you understand the VIX and the fear in the market, and now we could get into the next topic, which is understanding the overall macro environment. So when choosing stocks, or when choosing to get, swing trade or get long a position, we need to understand, are we in a bull market or a bear market? Should we be getting short a position or long, depending on the trend? The trend is your friend. You don't want to go against it, okay? Unless you're using the strategy that I do. It allows you to go against the trend and still make a lot of money, okay? So let's talk about that, understanding the macro environment. We are currently in a lowering interest rate environment. That means more money will be entering the markets. It's cheaper for businesses and consumers to borrow money and spend. That's good for the economy. That's good for stocks, okay? What I like to make sure that we're in a lowering interest rate environment, how I check that, because I'm bullish and I believe the stock market will continue going up, especially if we're in a lowering interest rate environment, you need to look at the CME FedWatch tool, okay? Look that up on Google, CME FedWatch. It's gonna bring you here, okay? It's a very important tool. Currently, the current interest rate is between 425 basis points and 450. Now, if we go to aggregated, we click on that, you're gonna see that this is the probabilities of the market pricing in an interest rate cut. So there is an interest rate cut priced in middle of the year, right? June, July, around June and July, August, a 92%, okay? So interest rates are being cut. This is bullish. We're in a bullish environment. So you can get long stocks on any dips and you'll be fine, right? There's another interest rate cut being priced in somewhere around next year, around April to July, right? Somewhere in between there. So that means next year, we're continuing to be bullish. We're in a lowering interest rate environment. Money is cheaper. They're printing more money. Everyone's spending more. Businesses are doing well. That is what you want to see. Once you see that they're not lowering interest rates or they're hiking interest rates, that's kind of what happened back here, okay? We're gonna go back to the bear market of 2022. They announced that they were lowering interest rate back, or they were going to increase interest rates back here in November of 2021. And then they for sure said it in December 2021. They were like, we're for sure going to be hiking rates. And that's when the market tanked. And they didn't announce that they were going to start lowering rates until back here in 2023. Okay. So somewhere around here, it was like March or April, somewhere around there. Once we did that, that's when the market started going back up. Okay. So now you understand the macro environment. You understand that when more money is borrowed by the US government via treasury bonds being auctioned off by their Federal Reserve, debt creates money, okay? When the government borrows money, that's debt. That's how money is created. More money plows into assets that appreciate, such as stocks and real estate. That's why we saw stocks and real estate in 2021 going up like crazy because interest rates were near zero, okay? So not understanding this creates uncertainty and can leave you with big losses. People think that, oh, there's going to be a big market crash or like a big bear market or recession, and they don't understand interest rates. So they don't participate and they're just scared forever. Understand that if interest rates are going lower, the market's going to continue upwards. Sure, there may be a crash or a dip, but you just buy the dip or you buy the crash and you're going to be golden. Okay. So let's go into the next key point here, which is identifying key levels on the chart. All right. So now I'm going to teach you about technical indicators, RSI, Bollinger Bands, key levels. Relative Strength Index, or RSI, is a momentum oscillator that measures overbought and oversold conditions. So if it's trading above 70, the stock's overbought. If it's trading below 30, the stock's oversold. Bollinger Bands measure how drastic price changes are and the probabilities that the price will revert back to the mean or revert back to the average. Let's go ahead and look at the chart so I could explain what I mean here, because it's pretty technical, especially if this is your first time ever hearing those words. So first, RSI, okay? RSI, like we said, if it's up here above 70, it's overbought. Like back here in July of 2024, you see that it went above this line and we had this huge run up in QQQ. All right, back here, when we had that crash, August 5th, we were at oversold levels. So that was a perfect time to potentially get into the stock, right? And of course, we rebounded. All right, now let's talk about the Bollinger Bands. So Bollinger Bands indicate that the stock is gonna stay between this lower Bollinger Band and upper Bollinger Band 95% of the time. These are 2 standard deviations away from the average price of the stock. That's what that means. And there's a 5% chance that we breach above the band. And when we do, we usually revert back to the mean. As you can see here, we breached above. This was a good time to get short, and the stock QQQ came down. Back here, we breached the lower Bollinger Band. This was a good time to buy, and the stock reverted back to the mean. Did it again here, touched the lower Bollinger Band, good time to buy, reverted back to the mean, right? So you could kind of use that as a long or short indicator. I love Bollinger Bands. They allow me to sell options at premium, awesome times, and allows me to time my trades very well. That's why I win 95% of the trades, okay? So yeah, those are the Bollinger Bands and the RSI. Now let's talk about choosing the right options strategy. Now we only like to sell options 95% of the time. Sometimes we buy options, but we like to sell options because that allows us to be right. That allows us to be the casino, not the player in the casino who's losing, right, 65% of the time. So when you're first trading options, you shouldn't be buying them. You should be selling them via vertical spreads for small accounts or cash secured puts and covered calls. This ensures you're winning 80 to 90% of the time versus losing 50 to 75% of the time with buying options and relying on stop losses. I don't use stop losses. You can buy options when you get more experience, and I'll go over an example. So for instance, to give you price levels here, like back here, I was selling options on QQQ when it was at the lower Bollinger Band at 500, right? And I was selling the 490 puts, meaning as long as QQQ did not go below this strike price by expiration, I got to keep a premium that someone paid me, right? Someone bought that option from me because they thought the stock was going to keep going down. But I know that there's only a 95% chance that the stock's going to go back up in here, and definitely not down here. This was like a 100% chance trade that I was going to win, right? So that's how I do it. I sell cash secured puts here, And if the stock does go down there by expiration, I would just buy the shares and hold it until the stock goes back up. So that's why I typically never lose on my trades, because I'm selling way below the Bollinger Band or above the Bollinger Band if I want to get short selling calls, okay? So that's how I'm doing it there. If I want to buy options, I only buy leaps, which are call options that expire in 365 days or more. And I only buy them when the stock hits the lower Bollinger Band. So this would have been a perfect time for QQQ, perfect time for QQQ, perfect time for QQQ. And the reason that is because leaps, when you buy an option, you have theta decay. Time works against you. Every day that goes by, you lose money. But when you sell options, every day that goes by, you gain money. So that's why I like selling, okay? So let's go ahead and jump into it. I'm going to show you on the Tasty Trade backtesting tool. We're going to be in the inflation-induced bear market because I want to show you how this works, all right? Like how this works super well in even bear markets. We're going to sell puts, okay? 20 delta, meaning the chances of the stock going down to that price are only 20%, okay, by expiration. We're going to do 30 days to expiration. I like to sell monthly contracts every 30 days. And we're only going to sell puts when the VIX is above, let's just say above 20. Okay, let's try that. All right. And we're going to run that back test. So yeah, if you were to have sold above, when the VIX is above 20, at least you'd be profitable in a bear market. But I was waiting until the VIX was 25. All right. Especially in a bear market. Okay. Up 21% for the bear market, selling puts. So I want to show you that this works. It also works, let's just go to the past 12 months and I was doing, 35 delta, okay? And I was selling, at many times, the VIX being at, 15, I was selling, right? And we could run the back test. So as you can see, past year, 37%, right? Versus 23% just buying and holding. So you would outperform the market selling puts when the VIX is, 15 or above, okay? So let's go ahead and place a trade. I would go, this is just one of my accounts, another account. We're gonna go into QQQ right now. Unfortunately, QQQ is at the top Bollinger Band, so this is not optimal, but let's see how far below we can get where the stock is trading since we're pretty bullish right now. So we're gonna go 30 days out, right? And let's just go to the 23 delta to be safe right here, 23. That means this particular strike price has a 23% chance of being in the money by expiration. So we could collect 416 bucks there. That's pretty good, right? And we'd be at the 520 strike. So 520 would be actually right here, which is not bad. That's still far below the stock, okay? So we have quite a ways of room to be right here, and we have 30 days to be right. So that's why time works in our favor with this. Now, if you wanted to do a small account strategy, you would basically sell the 520, and then you would buy the 515, which is called a vertical spread. I have a video on my channel like that, and you'd be risking basically 430 bucks to make 77, and this is a high probability trade, okay? So that's a small account trade. Now, I have more videos on this. I have a special strategy called the wheel strategy. That's something that I particularly follow very well, and that's gonna be in this video right here, okay? So if you wanna continue watching, this is how I execute this strategy that I showed you on a particular stock that has made me tens of thousands of dollars. So check that out, and I'll see you in the next one. Take care.